Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.37, I believe, which is up from last week's 6.36. Now, that might seem like a small difference, and whenever we talk about the average 30-year fix, this is always based on the Fed data, which is the interest rates on applications. This is the average in the U.S. But the U.S. 10-year yield, which if you go into the longer form video, you will know that this is how we gather our estimations for what the interest rates are looking like. And the 10-year yield is not looking too hot. So we are going to get into that in the full video and why it's been climbing up and what that means for you moving forward if you're trying to buy a home or refinance a home. So let's get on into it. Back over to the charts. So we are looking at the US 10-year yield, and as I said in the introduction video, I mean, it is not looking too hot. So I mean, it is looking hot and not in the good way. So this is the 10-year yield, and back in March, early March. So we had the yield down here to 3.924 was the low. And you probably would have seen rates, I would say probably in the fives. Usually there's a spread of like 1.5 to 2%. And this is on average, right? It's going to depend on your lender. But if we're if it's at, let's just round it up to 4. I mean, if it's at 4, like you're expecting like rates around like 5.5 to 6%, on average for lenders and investors in order for them to make what they believe to be a good profit. It has just been climbing, a little bit of a pullback and then climbing, and it's up to 4.687. That's really bad. So nobody wants bonds. We can see this blue line right here. This is the bond market. I mean, there's just been a massive sell-off, and we're going to get into why, but really it's the same thing I've been saying over and over and over and over again every week, that inflation is going to guide the way for us to make informed decisions about what it's looking like in the bond market. So what it's looking like with the US 10-year yield, and then what it's looking like with mortgage interest rates, right? So all of these things are related. So we have to pay attention to inflation. That's really going to be so important for understanding what is happening in the housing market as far as mortgage interest rates go. And then with mortgage interest rates, of course, that impacts demand from buyers, which is in turn going to impact the whole market structure of real estate and property values. So, no matter who you are, if you are involved in real estate, whether you're just a homeowner, if you're looking to buy your first property, if you're looking to refinance, this is all stuff that you really should be keeping an eye on. It's so important to really just understand the dynamics of the market and what is going on. Why are rates climbing? Why is this happening? Like I said, what's going to guide the way is inflation. So we're going to get into that in a little bit. But yeah, I mean, just not looking too hot. Now, nice little pullback from here, but this is 4.687, still above 4.5. And 4.5 is just like right around here. It was just this kind of area. Let me see if it's, right here it touched, came back down. Right here it touched, came back down, touched, came back down, and now up and above. Not a good look at all. If we want to go over and look at oil too, oil is a very important thing to pay attention to. Well, I guess, so the reason oil is important is, of course, you want to look at how oil is going to impact inflation. And all of this right here, even though this isn't climbing and we are seeing the US 10-year yield climb, this is still elevated oil. And this is still having what appears to be, at least to investors, a fairly significant impact on inflation. And this is because of the war in Iran. That's what's impacting oil. There's no ifs, ands, or buts about it. That's a reason. So let's get on over. Actually, you know what? I had that wrong in the intro. It looks like it was a slight dip from 6.37 to 6.36. But this is just on paper, on applications. There are so many things that impact this that, it's good to keep an eye on, and it can kind of give us, a ballpark number, but it's not, whether you're getting discount points, whether what your credit score is looking like, there's so many factors. What lender you go to, the spread that particular lender has. There's just so much that goes into this that, looking at this just isn't enough. We have to take a look at inflation. We have to take a look at the U.S. 10-year yield. So let's go on over, and I want to take a look at, and my apologies for not doing this video last week, so CPI, this is on the consumer level. This is, what Joe Schmo from down the street, this is what he feels, okay? CPI, this came in hot. 0.4 core. So core excludes food and energy. So you're going to have the exclusion of oil. But oil, of course, there's input costs to like transportation, right? So you're going to have the impacts of oil still spilling over into the core CPI. This is the month over month. So it's going to be April's, I believe. I think this is April. Nope. Oh, I don't know. Anyway, it's month over month. So this might be charting from the beginning of April to the beginning of May. Anyway, this is hot. So 0.4, expected 0.3, previous 0.2. Not terrible, but it's definitely climbing. It's not good. Inflation is climbing month over month. Non-core, weird enough, is at a 0.6 and it was expected to be at 0.6, and previously it was a 0.9. The year over year, though, so from last year to this year, 3.8, up from a 3.3, expected 3.7. So hot, not great. This 10-year bond, 4.47. People don't want the 10-year bond right now. That's why the yield is so high. Now, this is where it gets bad, and this is where you're going to see that yield really climb. This PPI. So this is the producer price index, and this is manufacturers, right? These are the people that are producing everything. And it doesn't have to spill down into the consumer, but it can, and it most likely will. This is manufacturers, right? So they could eat the cost and keep prices somewhat contained, or they can, slowly raise the cost to where the market accepts it. But this was a 1%. The forecast was 0.3. That's crazy. This is more than 3 times what the forecast was for inflation. And that's up from 0.2% month over month for the core. Non-core 1.4%. So we're really seeing the impact of oil on the producer side of things. Previously it was a 0.7. And yeah, 1.4, so doubled. Not good. That is not good at all. We do have a new Fed chairperson. Jerome Powell sadly will not be there anymore, but we do have Kevin Warsh. And he has a hard job right now, and we'll take a look at why later. Let's see. People still buying stuff. Actually, you know what? No, people are not buying stuff as much. So retail sales down. People aren't spending as much money. And then when we get to this week, let's see. We had pending home sales, 1.4, better than the expectation, but still less than the previous month. Home sales, not as good. We also have Thursday building permits and housing starts, and then manufacturing and services PMI. So, this is interesting to see. Is growth still happening, and like at what rate? Are prices going up, expanding? Are they contracting? I would imagine expanding, but Got to wait for that to come out. And then next week, holiday on Monday. I believe it's Memorial Day. And then we have PCE, GDP, unemployment. So Thursday, May 28th will be a big deal. And then we also have new home sales. Okay. Now let's see. What did I want to get to? Oh no, I want to look at this. Okay. So Kevin Warsh is coming in. This is Trump's guy, and Trump has been really insistent on rate cuts from the Fed and really pressed Jerome Powell and, was really pressing the Fed to cut rates. And we've been looking at this, and there was an expectation for 2 rate cuts in 2026, not happening now, just pauses. But in 2027, there was an expectation for at least 1 rate cut, and the rest pauses. Now it's a rate hike in 27. So, a lot can happen. This is just the probabilities, but it's not looking good. I mean, if this oil situation doesn't get under control, it's just the Fed is really stuck in between a rock and a hard place. Because also, rate cuts don't do anything to open the Strait of Hormuz. That still impacts oil, and oil seems to be such a driver right now for inflation. So, those people are smarter than me, so I guess they know what they're doing if they do happen to hike rates. So we will see. All right, that's all I got for you this week. Let's see. Okay, website load. There you go. All right, everyone, have a great week. Be sure to leave any comments, questions, or concerns down in the comment section. All right, if anyone has any questions about purchasing a home or refinancing, give us a call at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. Have a great day and a great week.